Good afternoon, everybody, and welcome to our continuing KoreSummit educational series. Today's session is Times Are Changing, Technology and Regulations. What comes first as we focus on Reg A's, Reg CF, and Reg D's. I'd like to thank our sponsor, Nuvei, payment provider of one of the world's leading payment gateway brands, and KoreConX. So the industry is maturing. 13 years, the Jobs Act has been in effect and signed into law. And with it, the rules and regulations evolve, as do the processes. So we're going to touch on the areas of legal, compliance, and a marketing perspective. It takes a team of successful team members, when you're raising capital. And today's panel of experts consists of, from a regulatory filing perspective, I'd like to welcome aboard Douglas Ruark from Reg D Resources, and Doug's the principal over there. Hey, great seeing you again, Doug. Always a pleasure.
Absolutely. Thanks, Peter.
And from the CEO of Textured Capital, Richard Johnson. Welcome aboard, Richard. Richard is a broker-dealer and gives us that perspective, as well as Textured Capital is also an ATS provider for secondary trading. And rounding out our panel is CEO of a digital niche agency and a leading investor acquisition and marketing firm, Jason Fishman. Jason, welcome. Great seeing you again.
Pleasure to be here.
So I always like to start with the regs and kind of do a recap, and because they're always changing, and how all of the different participants and intermediaries interact with them really revolves around keeping up to date all the time. So starting with the regulations, the first thing we look at is the pre-raise, whether it's a Reg A, a Reg D, or Reg CF. And Doug, I'm going to reach over to you because from a preparatory perspective, maybe you can give that high-level overview and background on the differences between the regs, and then we can dive into a little bit more on what's changing and how it's affecting all of us different participants.
Yeah, absolutely. So, really, when you go to raise private capital, you pretty much have three options these days, which is fantastic. I always tell people that, we're living in some really golden times right now for syndicating capital, because ultimately, prior to the Jobs Act, there just weren't these options. And I kind of like to break them up into the, kind of the simplistic, easy route, the kind of the middle ground, and then the more sophisticated route. Regulation D is the traditional private placement exemption. It's been around since 1982. There's really two primary programs people use under it these days. 506B, which is the old kind of traditional private placement program, and then 506C, which is the one that launched under the Jobs Act that lets you generally solicit the offering into the public, but you do have to keep that one limited to accredited investors. There is no maximum limits on those programs, so you can raise however much you want under a 12-month period with those Regulation D offerings. And really, what I tell people on the Reg Ds is the big benefit of the Reg Ds these days is the simplicity. That on the prep side, you're drafting some offering docs. There's a short notice filing to the SEC, but the lead up to launch is fairly short, fairly cost effective. There isn't a need for audited financials for something like a 506C, and so ultimately, when I'm working with a client and they're kind of evaluating these programs, that's kind of how I kind of pitch the Reg Ds. Is that it's the more simplistic route. It does have some limitations, so obviously 506C is going to limit you to just accredited investors. These days, if we're doing a 506B, it tends to be a pre-syndicated deal. So it would be something like, hey, Doug, I got 10 guys lined up to invest into this development project, and I got pre-existing relationships, but I am selling a membership interest in this LLC, so I need an offering. The middle ground option now are really these direct Reg CFs that we've been doing. And Reg CF again was a Jobs Act creation. Was limited to $1 million for a while, and then in March of 2021 they took the limit up to $5 million. And I really view these CFs as a great option for a client that needs to generally solicit the public. They want to raise money from everybody, but they're not maybe quite ready to step up to a Reg A yet. And so these CFs are nice because ultimately you're filing and executing under the Reg CF program. But if you're doing it in kind of the direct route, which is the way we do it, there'll be a custom raise portal built to run that raise, and then that launches with a broker dealer like Richard, where they're going to administer that and own that raise portal while you execute. And I think that the benefit there with that kind of model is you kind of get a mini Reg A plus. I mean, the investor experience is similar. The back end technology is almost identical. I mean, the KoreConX invest technology, there's not much difference, obviously, between the two as far as CF Reg A, but you've got a shorter lead up. We're not drafting a Form 1A for that CF. It's not going through a qualification process. And if you're keeping it at $1,235,000 or less, you're just looking at typically just reviewed financials. If you go above $1,235,000, you're coming in with audited financials. But you're getting out at a fraction of the time and cost of a Reg A, and you're getting similar investor acquisition capabilities. Reg A is kind of the top tier program at this point. It is the most sophisticated offering you could put in place as a private company. And ultimately, it is a fantastic program. That obviously was also something that came out through the Jobs Act. I don't think they really finalized and hit the federal record until 2015 with Tier 2. And most people are using Tier 2. There are two tiers with Reg A+. You have Tier 1, which limits you to $20 million in a 12-month period, and you have Tier 2, which caps at $75 million. One thing I'll mention is that you're not going to really place yourself into one of those programs based on the offering amount. You could do a $500,000 Tier 2 Reg A+ if you want, so don't think, well, we're under $20 million, we have to go into Tier 1. With Reg A, I mean, Tier 2 really is kind of the hot program, mainly because once you're federally qualified, you can sell in all 50 states, you can accommodate international investors, and you're not having to deal with state level qualification. Tier 1, you get federally qualified, but then you have to qualify in every state you want to offer and sell in. And so that may work in certain situations, but it can get cumbersome pretty quickly. Because ultimately, I think the big advantage of Reg A is you're executing what amounts to a public offering. So why not go ahead and execute under the program that lets you immediately sell in all 50 states once you're federally qualified? Reg A also has a couple other interesting facets to it. You have freely trading securities out of the gate. You also have a selling shareholder feature where up to 30% of the offering can be existing shareholders on your cap table selling their shares or their securities through that Reg A at whatever the Reg A offering price is. We're actually seeing a lot of real estate funds use that as another option for liquidity, that as they head into year 2, year 3, year 4, and they're running that fund and they're doing Reg A's each year, that they're able to offer that as an option to some of the investors that are on their cap table. Keep in mind, Reg A does have a longer lead time. The Form 1A is essentially an S1, so it is a granular, robust filing. And then that plus the exhibits are going to the SEC for qualification. As long as you got a good firm on board, the qualification process is not too onerous. And also keep in mind that you're going to be coming in with audited financials if you're filing under Tier 2. But those are really the three programs. And like I said, I think the benefit really is that there's a match now pretty much for what the client's looking for. If they just have a handful of people and they got pre-existing relationships and they want to have a compliant offering, there's an option. If they want to raise money from everybody and generally solicit, but they're not ready for a Reg A yet, great, do a direct Reg CF. And obviously, we're doing a lot of Reg A work for clients as well that kind of want that most sophisticated, most capable option.
Thanks for that, Doug. Thorough overview of all the three regulations. The regs have also changed somewhat when it gets into from the broker dealer, what the broker dealer has to do, and certainly what Jason has to do as far as monitoring the different regs. And they're not all created equal, both from a marketing perspective and both from a compliance perspective when it comes to it. So let me flip this over to Richard first for a sec on the broker dealer front. Doug mentioned things like on the Reg D that it's easier for the issuer potentially. I am limited to the number of shareholders that I can have, but what about the issuer? What I'm hearing a little bit when I look at different types of exemptions, such as CFs and As, is I can do general solicitation. I can do that on a Reg D, but only for that accredited investor. Now, if I'm an accredited investor, one of the the onerous task. And now I'm thinking the investor, not the issuer, doing the prep work that you're talking about, Doug. I've got to jump through some hoops. I've got to prove to you attestations. And I'll hand it over to you, Richard, because on a Reg A and a Reg CF, it's self-accreditation. If I indicate what my income is, the exemptions and the technology behind it are going to present to that investor how much capital, how much money they can actually invest in their offering. So, Richard, from a broker-dealer perspective, you're engaged with all three now. You're Reg A's, Reg D's from a compliance perspective. What's the transition, and what are some of the pros and cons that you've seen when your clients are getting engaged?
Yeah. I also want to reiterate that's a great summary from Doug at the beginning there. It's like Wikipedia for securities laws. That's brilliant. Touching on, I guess, all four of them, the 506B involves no general solicitation. So it's a closed knit. You can go out to investors who are in your network. And also for the 506B, the accreditation is a self-attestation again. 506C, which is also part of the Jobs Act, allows you to do general solicitation. So you can do marketing for it, only to accredited investors. What the SEC added, like the give and the get there, they gave you the general solicitation, but they wanted an affirmative determination that the investor was accredited. So there's three basic ways to determine accreditation now. You need to have income of $200,000 for the previous 2 years, a net worth of $1 million or more, excluding your primary residence, or a financial certification such as a Series 7 or a Series 82. So that's kind of limited to the securities industry. There is also talk right now, I think it's worth mentioning, of changing the accredited investor definition. A lot of folks have been looking at having a test. I think a lot of the industry would like there to be a test so that you can just kind of go in there, study, and prove that you're sophisticated, as opposed to having a wealth test. But I think what we're going to see from the SEC is, in fact, they're going to lift those bands more likely, because the 200,000 and the 1 million came into effect, I don't know the exact date, but 20 or 30 years ago. So they're not inflation adjusted. So that could be an issue. That could potentially put a lot of high net worth or previously accredited investors out of the picture. And what we are seeing a lot more of now, and have been working with you on, Peter, is the Reg A and the Reg CF, which opens up a whole new avenue for issuers, retail investors. And I think the advantages there, of course, are I think there's 8% of people in the US are accredited. Now you can go up to 100% of investors out there. So a big difference there. Again, the SEC was, there was a lot of pressure to do this. The Jobs Act, of course, stands for Jumpstart Our Business Startups. And although it was signed in 2012, came into law in 2015, it is actually an artifact of the financial crisis, where, if you're old enough to remember that, as I am, the world was falling apart, and Obama administration was very worried about the economy. And this was an idea to help provide new sources of capital to early stage startups, which of course is also one of the SEC's missions. So they wanted to kind of bring retail investors in, but another part of their mission, another pillar, is they want to protect investors. So there are some protections put in place around that, such as you can't invest more than 10% of your income. And for Reg CF, there's a kind of a cooling off period. You have 48 hours to cancel your investment if you change your mind, and so forth. So this is so what you're looking at there is potentially, if you are an issuer doing either Reg A or Reg CF, as opposed to, I don't know, maybe 10 investors in a 506B who are friends and family, going to maybe 30 or 40 in a 506C where you're doing general solicitation, you're looking at hundreds or even a couple thousand investors in a Reg A or Reg CF. So the administrative side becomes a lot more complicated. For all these investors, you've got to do the wealth checks and so forth. And that's why it's really essential, frankly, to have a platform like yours that's got the integrations, makes our life a lot easier, makes the issuer's life a lot easier. It's really kind of, it's matured to a point now in 2023 that it is, not just a viable option. It's not just that and there was a stigma around crowdfunding. I think that's gone away, but I think it's going to be the go-to going forward, especially in this market. As I mentioned, accredited investor definition likely going up, getting harder. Venture capital is drying up. And a lot more companies are just turning to this because it works, and also it helps kind of connect them with their community, so their customers can become investors, and that makes them even better customers going forward. So it's I think it's a win-win for issuers and investors, and I think we're going to see a lot more of it going forward.
Well said. I think we're seeing the growth. We're seeing more and more companies utilizing it, and it doesn't mean that they're all successful. By the way, the audience really needs to understand it does take a team. And I'm going to switch over from the marketing perspective. So if we know that we can take these exemptions and we can do general solicitation to the crowd, which is virtually anybody. And Richard, you made a really interesting comment on 8%. Let's say, accredited investors.
I had a little bit of a guess, but I think
but it's a small amount to go through the process. However, there's a significant swath of individuals that are high net worth individuals. They just want to go through the process. That's the other interesting thing about the exemptions, especially when they're Reg A. A lot of people think that a CF is for the wide sweeping across for anybody. So is a Reg A. But the minimum investment on a Reg A versus a Reg CF can be, and we've seen it, we work with companies, their minimum investments are $5, $10, even $100,000 a minimum investment, and they're attracting high net worth individuals and the accredited investor with less friction for those investors. So that's just something else, something to consider. So we've got the pre-raise going on. You got to make those decisions. You've got to talk to smart legal prep firms, and those that just do this all the time. You need your broker dealer, and we're going to dive heavy into the compliance side, but the heaviest lift of all, well, maybe not of all, it's certainly it's the linchpin to all of this and success rates is the marketing. So Jason, from a pre-raise where we're at today, what are you seeing and what are you recommending when companies say, hey, I know you're doing Reg Ds, and I know you're doing Reg CFs, and I know you're doing Reg As. Are you treating them the same, differently? Are they nuanced? Share some insights on that.
Absolutely. And want to build off some of the comments here. I mean, we've been working on Reg D campaigns, 506C, as Douglas was mentioning, that allows for solicitation. So we've been able to advertise, to market to accredited investors. There is audience data that's available for these media buys. So as Richard was breaking down, $200K individual income over the past 2 years, $1 million net worth outside of your primary home. There are plenty of financial data providers that'll give you access to audiences that you can use for advertising. It won't show names, addresses, anything personal, but you can run ads specifically to those audiences and measure traffic that is going to an offering page, in many cases, a landing page, because it's going to be a longer sales cycle. That's the biggest distinction I can make. There's misconceptions in general. We started working on Reg CF in 2016, right out of the gate. May of 2016 had advertising live day one. It's still not a first touch conversion. And I think that's important to look at during the planning. Don't anticipate audiences getting to your offering page and investing right there, regardless of the filing. Retail investors, sure, they can get excited by the crowd, by social dynamics, but it's not, flashing a shiny object and they're putting in their personal information, their payment information right there. It's going to be 7 touch points more on average before they actually move forward. You want to be intentional about what they see when they're searching around and doing their due diligence. They should see momentum, traction on a weekly basis, if not more. If your campaign is stagnant, the investors will feel it. Prospective investors will feel that. Reg D, going back, even longer sales cycle. It could be weeks. It could be months. It can be a longer period before those individuals that you're targeting that, hey, they're accredited. They're seeing ads, emails, direct mail, phone calls every day about deal flow. It's going to take a lot longer for them to move forward. I mean, the levels were set around a projection of more financial education and experience, also more ability for losses. So they're a lot more comfortable looking at these deals. I look at digital marketing for Reg D more as lead generation and lead nurturing. We'll see a lot of these deals incorporate an offline touch, whether that's a call, a video call, an in-person meeting. Always recommend starting closer geographical locations and targets, even though you could market nationwide. Proximity has a power to it. And even if someone is in your city but doesn't opt to meet with you, just knowing they're nearby makes a difference psychologically. But being able to, go after these audiences with ads, with outreach, take them down a marketing funnel, different types of content. As silly as it may sound, social media still ranks high in the sites. People are searching around for you and they get to your social media platforms and nothing's there. It says something. If they get there, and there are all types of elements of social proof, third-party validation. Hey, you're speaking at this conference this week, this podcast last week. Look at this new partnership. Look at this new deal. That in my opinion, checks a lot of boxes for prospective investors. So being able to build that trail to then nurture audiences. Yes, the average investment's higher for Reg D. The minimums are higher. Yes, we see volume on Reg CF and Reg A, and those audiences, as Richard said, could turn to user owners. I've written articles about that. I really do believe that is a premium audience today. We wrapped a Reg CF last week that sold out. They're 4.5 million in shares, high volume of investors. Those are now ambassadors, advocates promoting the business. They have an interest in the organization. So there are pros and cons each ways. We've worked on side-by-sides with the Reg CF, Reg D, simultaneously running as well. And there's a lot more commonalities from the marketing side. Yes, we have to change the audience personas. Yes, we have to make a longer content funnel. The messaging is going to differ from an accredited to a retail campaign, but we're targeting investors at scale using digital tools and taking them down marketing funnels to convert them over time across any of these approaches.
So what I'm really hearing, and nothing's really changed, whether I'm selling a product or I'm engaging somebody from an e-commerce perspective in that world, I have to develop trust. At the end of the day, I have to develop trust. And how do I develop trust? And it's not just, as you've indicated, whether I'm putting an offering up on my own web property, which we'll discuss a little bit, because this is kind of an evolution that's affected the broker dealers since CFs went up to $5 million. Traditionally, it was all on a funding platform. I'm listed on a funding platform with lots of other offerings. And that's a great place, by the way, for lots of companies to list their offering. We're tech behind both funding platforms and what we call direct issuance. So the other one is I've got my own page. So Jason, would you think that it really depends on the type of company in some cases as well, would it not? To say, if I'm a consumer goods company and I'm building my brand, and my investor may potentially also be my consumer of my product, and I want to capture that data for multiple purposes, can I cross-reference my marketing efforts in that regard to say, I'm building my brand, I'm getting consumers, and I'm also getting investors, and maybe a direct issuance fits that world? What's your take on that?
Absolutely. And I picture more and more of that to come over the years. I think it'll be far more common for these marketing funnels, the steps that an individual goes through online, referring to the funnel, taking audiences from awareness to consideration to intent. Those who intend, there's still a drop off. There's still a conversion rate for those who actually convert. On a Reg CF, we'll see 10 to 30% of the audience convert multiple times, especially during the closing messaging and depending on their intro level buy. And then advocacy, that peer-to-peer marketing is ultimate. It's like you said, Peter, people don't believe what they see on the internet. Trust is key. And we look for different signals, whether we're buying an e-commerce product or whether we're buying shares in a publicly traded company, a privately traded company. We look for that as individuals. We want that line around the block feeling. So that can be created, and the analytics can benefit for either route. I envision funnels, and we're running this for different issuers today and have done so, for several years now. It doesn't work out for every type of vertical like you're mentioning, but where we have customers come in, and after they make a purchase, they're receiving an email, they're receiving different content, maybe some ad retargeting of opportunities to now become a shareholder in the organization, and vice versa. Someone comes in as an investor, and now they're being pointed back to the product. Maybe there's a lifetime or a one-time discount, and pointing towards the e-commerce side of things. I say e-commerce, it can be a software and an app install. I'll tell you, this happens in the B2B space as well with strategic investors, venture capital, angel investors. It's always shown there is value to bring in a strategic investor that benefits from the success of your company and maybe is in your industry or supporting industry. I've seen all types of things come out from B2B conversations. Some of our top campaigns to date have been B2B. If you're listening into this, do not think Reg CF and Reg A is just B2B. If you look at the charts, the analytic platforms, a lot of the top companies have been B2B. And I could tell you, I've seen franchise conversations, M&A conversations, various types of B2B sales and partnerships come out of these initiatives.
And you bring up a really good point there. It doesn't have to be to B2C. It doesn't have to be B2B. It could be companies that are in the government space, companies that are manufacturing. Yes. So the types of companies that I've seen everything under the sun. One of the questions first I'm going to make a comment, and Richard might be able to give me some insight on this, is you mentioned the comment of reinvesting. So one of the things from a technology standpoint is technologies evolve from platform providers to allow those investors to reinvest. But it's tricky. You got to make sure that you're compliant. I can't just capture your data. This isn't the e-commerce world. I'm dealing with digital securities here. So if I'm going to allow that investor to reinvest, there's certain tech and processes, compliance involved, so that I can make their life easy to make that reinvestment. And we've seen companies that have had as high as 50% reinvestment. One, they got the trust. Small investor might have said, dip my toe into. Secondly, they might have had a deliverable. In the case of real estate, might have been dividends or something like that. But if you're not communicating with that investor and your broker dealer isn't set up to actually move those investors from that application through the KYC, ID verification, anti-money laundering checks, all these things that are happening behind the scenes, then you're creating friction. And Richard, when it gets into like the Reg CFs, for example, and compliance versus CFs and A's and D's, they're not all the same, are they?
Well, there's quite a significant compliance burden. As you said, we've got to make sure that they have first of all, there's the KYC, there's the AML. We've got to make sure they pass those checks. If they are accredited, which they can be, of course, we've got to check that as well. And then, of course, making sure that and by the way, that's not easy. We're looking at kind of, social security numbers, matching that up with driver's licenses and addresses so that we understand that the person who is investing is really that person. That's a very important part of it. And then also there's, matching the investments to the payments. As I said, you could be getting in hundreds of thousands of payments of $100 or maybe even less than that. So there is a lot of compliance overhead on that. And, we work with you guys and the escrow providers to make sure that all goes through quite smoothly. I wanted to kind of, if I can, track back to something else you mentioned and make sure that everyone understands what we're talking about, because some people may be new to this space. You said earlier, Peter, that you can kind of invest from your own page, from your own website. And this is something people are more recently taking advantage of. Often when people think of kind of crowdfunding or Reg A, you think of some of those well-known platforms. And as you said, your offering is going to be up there with with the Beanie Babies and the robots and whatever else it is. So there's a lot of noise and distraction around there. But what you can do now, using our technology and your technology, is create your own investment page off your own website. So if you have a lot of traffic, that's great. But even if you don't, you can use someone like Jason to help bring that traffic to you. Now, initially, you may be thinking, well, why do I have to spend all this money on a marketing agency for this, when I can go to one of these larger platforms? Well, the thing is, even if you go to a larger platform, like, with that is a kind of a marketplace, as it were, they're not going to do any marketing for you until you get to whatever it is, 100,000 or 200,000 anyway. So you've got to bring in the first stage of investors. And the other thing is that you will then own, if you go down this route where you have your own invest page, you will own those investors. They'll be yours. You won't be sharing them with anyone else on the other platform. And you can potentially use them for not just investments, but also market them for your products and services. So I think that's a real innovation we've seen recently, and a lot of firms, because it's given the technology that we've all been building, it's getting a lot easier to do.
So you brought up something. It becomes easier to do, but a real risk factor is the compliance side of it. So this is what people, so all of these environments are regulated, highly regulated. Funding platforms are regulated by FINRA, broker-dealers are regulated by FINRA. I want to put up a web page and I want to put some tech on it. And that might seem easy on the surface, but there's something that occurs out there, and Jason, you'd be aware of building offering pages. You've got to, on a Reg CF, you're actually handing over that offering page and that web page when you go live to whom? The broker-dealer. Maybe you guys can, and Doug, you're involved in web pages with your firm as well. So all three of you guys have been involved in this, but at the end of the day, the broker-dealer is what? The insurance policy and the compliance advocate. Well, he's actually more than an advocate. He's doing the compliance for you, but they're protecting you at the issuer at the same time. They're going to maybe want to go through that, touch on that, any one of you, just what that really looks like and when that, the keys, so to speak, when you go live on a Reg CF gets handed over to the broker.
Yeah, I mean, I'll speak real quick to that. I mean, I think, first of all, one of the things that we're seeing as far as people gravitating more towards like the CFs and Reg A's is the investment process itself. I mean, anybody that's used KoreConX's invest technology or at least demoed it, it's 3 minutes, it's seamless. I mean, it's sophisticated. It's all automatic. It's a touch-free process for the executives of the issuer. And that's just fantastic. I mean, that's one of the things to me that's been fun over the last, 10 to 15 years is really watching the technology evolve. I think when it comes to the raise pages, like on these CFs where, the raise page gets built, it's custom built for the issuer. It'll run on a domain of their choice. That domain just has to be owned by the broker-dealer. It will launch with the broker-dealer. The broker-dealer is going to own and administer that raise portal website. One of the things that I found, though, and I kind of call it the trifecta of trust on these CFs, is the broker-dealer, the KoreConX transfer agent, and then escrow. And I think ultimately when you have those three vendors on board, it really does build trust with investors. Because when I go to that raise portal, right? Oh man, there's a broker-dealer on this. There's SEC transfer agent. There's third-party escrow here. And it's just a more sophisticated offering than something like a Reg D. And I'm not dismissing Reg D as an invalid option because it is a great option for a lot of companies. But I have seen a lot of companies that would have defaulted to a Reg D going into these CFs because they want that streamlined investment process. They obviously want to raise money from everybody, but that trifecta of trust, those three vendors on board really bring a lot of value into the equation and really help build trust with investors.
No, I appreciate all that, the comments that you made on that, Doug, because look, we've kissed a lot of frogs from a technology perspective. We have to integrate with a lot of different participants and partners. And I use that term loosely, but what I'm really saying is as the regulations keep getting modified and tweaked, there's significant data capture requirements. And this is for the investors, that data, making sure their investment is secure. This is for the issuers, making sure that they have a chain of events, a chain of record keeping, a chain of emails, a chain that technology is facilitating today, because right now the SEC and FINRA, they do audits all the time. They say, hey, show me in a Reg CF the email that you sent to these 10 investors that they had there, as Richard said, 48 hours before the close of the offering to get out of that investment. And if you can't show that, you're not compliant. If you don't have that documented in some way, you're not compliant. So this is a little bit different than just saying, hey, I'm going to set up an email server and I'm going to set up a payment gateway and I'm going to set up an escrow provider. I need a chain of events, and hence chain. So in our world, we operate on a permission blockchain. And what that really means is just efficiencies. It allows us to connect to participants and have a record of everything that's going on between all these trusted participants, so that at any point in time, the individuals have access to information and data. And that becomes really, and it changes all the time. When I say what changes, the requirements, say by FINRA or the SEC, to say, oh, we need to capture this information, or what about this information? And I got to make a comment or dovetail into something you mentioned, escrow, Doug, that was brought to my attention recently, and I didn't even know, for example. So because we connect with the escrow providers and the payment rail providers. And we want to make that flow of that application for that investor as quick, as fast, as easy, so the broker can finish their job more efficiently, but most importantly, so the issuer can get their funds. And if they get their funds quicker, they can take some of those use of proceeds to do what? Throw it back into the marketing side, which is that lift that Jason, so the faster we can do that, you don't want hey, I raised $3 million and it's sitting in a bank for 6 months because I can't have access to it for my closes. So it's important to note that technology can help facilitate that. But an escrow provider brought something to my attention that recently. So information gets captured from the investors early up front, and that information it's going to ask for like my social security number, my driver's license number, a lot of personal information. I've had issuers or companies say, well, Peter, I heard that I really don't need this piece of information. And I said, oh, where'd you hear that from? And I'm going, we're the tech provider, but can you turn it off? And I go, yeah, technology, we can turn anything off. I don't want to capture your driver's license, don't want to capture your social security number. We want to do it in a way that protects the investor. But if you don't want to, you could turn it off. We unfortunately won't turn it off for different reasons. But technology, you can do that. And I bring that to the attention because one participant in an offering application might say, I don't need that. But as it goes through and you connect the dots, the bank at the other end, being the escrow provider, this escrow provider said, I just assumed that everybody was collecting things like driver's license. I don't need it today. I need to know that somebody has it so that if I need to have access to that information, I can get it. And that's a big mistake that a lot of individuals are looking at. Even in the legal community, by law, do I need a broker-dealer for a Reg A offering? No, I just likely can't transact. So it's kind of pointless in that regard. How I can't transact because if I can't use credit cards and ACH because the payment gateways are saying I need a trusted intermediary involved, such as a broker-dealer, and doing compliance, it's kind of pointless. So you got to be careful to say one piece of the law might apply as a truism, but it may not apply as far as your ability to transact. Does that make sense, gentlemen? Like as far as it's an end-to-end environment that you have to look at.
Yeah, I mean, I think going back to what Doug said, that the trifecta of trust, or whatever, however you termed it, we're here to help protect investors and the issuers. So we want to make sure that the issuers may come to you or to me and say, oh, why do they have to click all these buttons? Why can't they just send us the money? Well, we want to protect you and make sure you follow the securities regulations. That's number one. So you follow it this way, then you're going to have a compliant offering, and it's going to be successful, and you're not going to have the SEC knocking on your door a year later or something like that. And on the other side, we want to protect the investors as well. So we will make sure, as a broker-dealer, we monitor, or we review and make sure that the offering pages are fully compliant with FINRA regulations around marketing and communications, making sure the issuer is not saying something they shouldn't be, not saying guaranteeing profits or returns or anything like that. So and trying to give a balanced objective view to the investors so they can make their own decisions. So that's really, I think what we're able to do together is create a safe environment for both sides, both the issuers and the investors.
Hey, thanks. You're right. It's again, it boils back down to trust, doesn't it? Mm. And how do you take the friction out? And it definitely sounds like a team that you have to build around yourself. And that lends itself to not just a team, but transparency. So one of the big, I'm a huge fan and an advocate and of everything being transparent. What are my costs? And I always indicate to companies raising capital, your lift is the marketing. I mean, we all love the world that we live in, and we hopefully do our jobs the best. But without good, solid marketing, whether you're doing it yourself, whether you're using a firm like Jason's firm to do everything, or piece to your puzzle, whatever that means, the marketing's key. So the more money that you're not spending on technology, on credit card fees, on ACH fees, you have to look at everything unbundled. I just had a note to myself here that somebody texted me that says, hey, well, what do credit card fees cost? So I've seen credit card fees go from approximately, say, 2.89% to 5%. And on the surface, you think common sense, that's a pretty big number. Well, start to dial it in. I've had companies do $30 million raises. That 1 point represents $10,000 per million. You just took $300,000 and threw it on the ground. So when you're looking at all of this, don't just look at what's my upfront cost. Let's look at what are my ongoing costs while I'm doing the raise, because that 300,000 could have gone to the marketing efforts, and that's what companies need to snowball. And when I say snowball, had a discussion with a particular issuer, 5 raises, highly successful. One of those poster child kind of raises. Won't get into names but they do 5 raises, and they said, hey, we spent like $200,000 a month when we started out doing this big Reg A offering, and we're looking at $60 million, which they got it, by the way, and they were scared. But they said once they got the trust level going, once they got the momentum going, that spend grows exponentially. But if they don't have the money up front because they are giving it away to the payment rail providers and the escrow providers, or what I refer to touch fees. Oh, I didn't know that it cost me $12, $20 every time that investor signs a document. All those fees add up. So just to our audience here, I really strongly recommend split it all out. Understand what all your associated costs are, because it's your money coming in, and you're only as successful as what you get to keep and what you can use to continue to grow your business and your marketing efforts. Jason, have you, with the clients you've worked with, because you don't control, if they're working on payment rail A, B, C, and you've worked on different platforms and things. Have you seen any things at least becoming more transparent and more favorable to the issuers so they understand all their costs?
Absolutely. I think a lot of the pain points with issuers years past, when it was more of those portals, like Richard was mentioning, almost like a Kickstarter and Indiegogo, but for securities, was a lack of data, a lack of transparency on what was occurring. If you look at the pros and cons of self-publishing versus being on a portal, having all of that data, having the transparency, being focused on what you're setting up and what that investor experience is going to be like, and all the way through can make all of the difference. A jump from 1% to 2% as a conversion rate is astronomical for one of these campaigns from the digital marketing perspective. Google says an average conversion rate across all of online sites is 2.35%. If you round that to 2%, you may need 50,000 visitors, let's say on a Reg CF or Reg A, to get 1,000 investors. And if on Reg CF you're seeing $1,000 average investment, if on Reg A you're seeing a $2,500 average investment, that's only $2.5 million, where a lot of issuers are looking to raise more. So they need 50, 100, 250, millions of actual visits to the offering page, not just awareness of the deal, not just a post on social or being featured on an email, but actually having that email drive the traffic to the offering page. So you want to do whatever you can to ensure that the conversion rate optimization is, an ongoing practice and to its fullest abilities. Was talking about peer-to-peer marketing earlier and didn't get to finish into audience. If an issuer has a pre-existing audience, they still have to get them over to the offering page and see these conversion rates and make sure that trust is very present throughout that entire funnel, throughout that entire 3 minutes. And that's why it's so important, as Doug mentioned, to have the broker dealer, the transfer agent, the escrow all featured there, checking more boxes. Again, not everyone believes what they see online. The internet used to be littered with scams, still is in many perspectives. So you want to make sure that is at the forefront. And if you're bringing your audience there, make sure it's a streamlined checkout as you're marketing to more audiences, and you're being able to point at all of the validation from your existing connections, your existing customer base, your existing partner base. Hey, we've had $1 million raised, over 1,000 investors to date. You'll see your conversion rate go up and up and up and up. If you're in planning right now and you're going through all the tech stack decisions, which are crucial, as Peter's pointing out here, also look at audience building. there's a compliant way to do this. Don't prime the market, but at the same time, if you're building your customer base up, and if you know it's high net worth, high household income audiences, you may be able to make this opportunity available to them in day one, week one, see a stronger performance as a result. I see marketing as an afterthought way too often. And we're brought to a campaign that's been stagnant for 6 weeks. And now they're trying to figure it out. And we're scrambling and skipping our normal strategy process and looking to just get ads up because that's traffic to their offering page, looking to seed some relationships with publishers or financial email newsletters, but trying to do whatever we can to get those conversions and quick. I would say start today, look at these, pre-planning, planning phases as a value, and definitely come out of the gate strong with your offering and continue to retarget all the way through. A lot of those individuals will convert during the closing messaging, unfortunately, but the more traction you're able to show early on, the stronger chance of success that your raise has.
Okay. So all of the marketing pieces that somebody has to look at, are they the same today as they used to be? I talked to folks that are in the e-commerce space, and they said some of the things that I did 5 years ago in my social media campaigns, I've got to be smarter, quicker, faster, and perhaps different. What worked with you 4 years ago, 5 years ago? Is it working today, or is it changing?
The biggest thing I could point at that changed is actually around privacy and security, but affects us in the world of advertising, and that is pixel tracking. So in late April, early May of 2021, iOS 14.5 came out, and that update, as well as later updates, requires users to give mobile app publishers permission to track them off app, meaning you have to give Facebook permission to trust you off of Facebook, and the auto option is no. So less than 5% of mobile Apple users are actually allowing Facebook to do that. So there is no pixel tracking for that 95% of audience off app. We could do lead forms on the app. We could look at who's clicking on the app. You then have non-Apple users. You have desktop, laptop users. You could track about a third of the conversions, but you're only getting a piece of the analytics. So there's enough there to be able to make data-driven decisions, but it's not always what a founder wants to see to instill enough confidence to spend more on advertising, to buy more traffic. If they're seeing a 3x return on advertising spend, it may be a 9x. It may be higher. We may be able to show them with other, Google Analytics and other reports, trying to make sense on the attribution where traffic is coming from. But because it's not staring at the issuer directly, there's more question marks. And I've seen campaigns that should have scaled and have been brought to our attention, and I'm pointing out they're actually getting better performance than they thought. I've seen clients of ours hesitant to scale. I would say that's the biggest piece. And as always, fatigue comes with repetition. So whether it's influencers who were huge 3 years ago, 5 years ago, and I'm including, bloggers, financial analysts, and anybody online. This doesn't just mean the, stereotypical Coachella hanging out by the pool influencer. I'm talking about actual people in the startup community, in the venture community. They've talked about that many more deals since then. The financial email newsletters, same concept. We've seen a lot of them come and go in that period of time. Some due to compliance, some due to overall ineffectiveness over time of their promotions, maybe their deal quality. But the landscape is ever changing in that regard. So I try not to enter a marketing campaign without doing a thorough competitor marketing audit. You need to see what the top brands in the space are doing today, not 2 months ago, because your ads are going to be running alongside theirs. You're going to be competing for the same earned media, the same features in different financial publishers. You're on a portal, you're going to be on the same emails as them. So you need to make sure you're mapping out and you know exactly how they're taking on market share, the exact messaging that's converting them today. If they're doing webinars and the type of guests, maybe you should consider doing some. Know what ads are running on Facebook, on Google, on any channel. Look at what portal updates they're putting out, what conferences they're speaking out. Sign up for their email. Success leaves clues. SWOT analysis, strengths, weaknesses, opportunities, threats is basic. So it's ever changing. There are absolutely things that don't work, that crushed and the top campaigns were doing a few years ago. So you need to be up to date.
Hey, so we got a good question here that's right in your alley or your lane here, and this is open to anybody. This gets into the compliance world, but somewhat more on the marketing side. One of the viewers is asking, they're planning a Wall Street Journal series of ads aimed at industrial users for their technology suite. So their focus. We have a link to our investment page of a website. Can we include your internet destination information in to serve this capital raising purpose also? Not sure I quite 100%.
Yeah, I think what Mark, and he actually just added another comment. So I think what he's asking is, in that advertising, could he have something in there that maybe links over to the raise page as well? And Mark, you correct me if I'm wrong, but ultimately you certainly could have a link to a raise page. But I think one of the things to keep in mind is that there are rules regarding what's going to go into advertising. A good example of that is on the Reg CFs. You're not allowed to put offering terms in the ad. Now, I don't know as you'd want to clutter up your ad anyway, and Jason would probably agree with this, where it's like, hey, we're raising capital, we're selling convertible preferred shares at, these terms and stuff. I mean, you don't have the time for that, right? Like, I mean, Jason's the expert on marketing, but I'm sure he'd say, when you're putting advertising out, it's really there to grab people and obviously get them to a raise page. And you don't want to clutter up that advertising with a bunch of securities terms. It's more, hey, here's why we're going to be successful. Here's why you want to take a look at us. Click here to go to our raise page. So yeah, I think ultimately it would depend on the type of offering. If it was a Reg CF, you could, but you've got to be careful about the content going into that ad. And I think also if this ad is a combination of promoting your products and services, plus also a call to action to maybe come invest, you might want to consider separating those. Again, that'd be a good one for Jason because he's the marketing guy. Yeah, I think it would be one of those things where you'd want to get, some proper guidance on that as far as the advertising and what's going in that advertising to make sure you don't violate any rules.
Yeah, I think the key, and Jason, you are the expert in this. The key is, yes, you can have inbound links to say, are you interested in that? It's just the content that's going around that link prior to going to your offering page, whether it's a CF or Reg A, and the rules are a little different between the two, is my understanding, and your Reg D. But yes, you can have inbound links. That's one of the whole key things that you can do. Just make sure your content's accurate. Jason.
Yes, and run everything by legal. So folks like Douglas, make sure that it's signed off. As Doug was mentioning, there's tombstone and non-tombstone information, and you have to choose one route or the other. You cannot mix. As Douglas said, that would be a violation. And what I can add to the conversation here is we never run one ad. It's always variant testing. So if we're running 4 ads week 1, 4 ads week 2, 4 to 8 ads live at any given time, and switching out evergreen that are performing, and we're continuing to run and testing new ones at all times, we're letting the data show us what's working best. We're testing different audiences, different messaging, and different funnels. Different audiences to get a gauge on who's responding the best, the messaging, including the visuals, creative, I should call it, to see what's getting the best response, not just on the click-through rate, because as Douglas said, that first ad's just about getting people to the offering page. You want to set them up. You want to have the right state of mind when they're going in. You don't want to set false expectations by any means. You don't want to fool them and they think they're buying a product and then they see an investment opportunity. But we're looking at the data to see how the messaging is working, and then the funnel. And to your question there, we want the analytics to show us which route's better. If it's to a landing page compliantly and they're signing up for a webinar or a lead magnet or getting their email address submitted there, and then email is converting them later, and we're driving them to the offering page after they've submitted that. If it's directly to the offering page, you can variant test different routes, again, against audience messaging and funnel, and the analytics will show you what to do more of. And that's why it's so important to have A/B tests, because if your hands are tied to just one, you may write off a whole channel.
And there's entire books written just on the nuance of words and how these words are going to make me go from A to B versus those words. And that's where marketing firms are super, super critical. We got some really good questions here coming up. So a couple of the areas where in the sectors, and all 3 of you have experience in different sectors, and all sectors for Reg A's, Reg CFs, and Ds. The question was on to do with a Reg CF and a Reg A. What are there any sectors that you're experiencing greater uplift than others, or some sectors? My experience has been I've seen 2 vodka companies, one's highly successful and one falls flat. Why is that? What comes down to the marketing and the messaging. But as far as in generalities, Richard, Doug, sectors?
Yeah, I mean, I'll jump in real quick. I would say that right now, as far as the real estate goes, well, first of all, we are doing a lot of direct CFs for real estate operators. I mean, once they took the limit up to 5 million, that opened up a lot of infill site development projects. It opened up single asset acquisitions, and it also opened up at least a starter round for someone doing a multi-asset fund. And so ultimately now we are seeing a lot of people where they'll kind of stair step it. They'll start with a Reg CF for, say, a real estate fund. They're going to raise 5 million in equity. They'll probably have some leverage. So they might have, 20, 25 million in purchasing power, which for something like if they're going to go buy like VRBO rentals or maybe small like self-storage facilities, stuff like that. I mean, it's a great kind of starter round. And then, then they may scale up to something like a Reg A plus. What I'm not seeing, and I will probably expect to see here pretty soon, just like we saw in 09 and 2010, is commercial real estate. I do think that there's going to be a point where people are going to start putting some funds together to go acquire distressed commercial real estate assets. We're seeing, obviously a lot of news coming out where valuations are dropping and, loan amounts are exceeding valuations and what have you. And it's putting a lot of these property owners in distress. So I think ultimately that fallout is probably going to really start kind of coming to a head here over the next year or two. So I am expecting to start having the phone ring like it did in 09 and 2010, where, pretty sharp people want to put some funds together to go buy some of these distressed commercial real estate assets. We are still seeing multifamily is strong. We're seeing development projects. So ultimately, real estate is still a strong sector for using these programs. And like I said, we are seeing people step into these CFs now because of that limit going up to 5 million.
Mm-hmm.
No, well,
I'd agree with what Doug said there on the real estate. We certainly see a lot of that. Other than that, I think that's just a very popular. Is one of the most popular asset classes to invest in. Other than that, I'd say it's fairly spread out from companies in the kind of consumer goods to biotech to technology and so forth. One thing I want to add that I think is a very interesting new development, though, is around fractional marketplaces. These are firms that are using a Series LLC structure in conjunction with a Reg A offering. This is what Masterworks does, for example, but allows the company to offer fractional investments in a series of different types of products that are similar. And each one is a separate LLC. You go through the Reg A process, and you do that with the SEC, you get qualified. But after that, each new asset, each new series LLC is a post-qualification amendment. So we're seeing a lot of people taking advantage of this combination of series LLCs and Reg A's to help get retail investors into previously inaccessible alternative asset classes.
Richard, you're letting me segue into something that's near and dear to my heart, and that happens to be what the topic of today was, to say, is it the regulations or the technology? What comes first? And I think we're coming to it's the regulations, especially when you get into the area that you just said. You discussed about, and Doug's done a lot of work with what we call series LLCs. I'm going to raise 75 million and I can have multiple offering in a series. That's being dovetailed into what we call a marketplace. And a marketplace is, like you said, a Masterworks. They have a buy-sell side. And this is also where companies like Texture can say, hey, we can facilitate the buy-sell side, but you need an audience. I need enough investors on the buy side in order for that to community work. The concept of a marketplace now, and I'm excited because we're building marketplaces now. Everything that we're doing is API driven. So it's kind of a shout out to KoreConX, an API driven marketplace. And I got a smile on my face because we're doing it and we're seeing these huge opportunities for companies that say, I want to build my world. And their world is, I've got lots of product, whether that product is art or that product might be real estate. And I'm going to build an investor community that can take pieces of things. Now, we've all heard this term, or many of us have heard the term tokenization. Well, It's just a representation of an asset. But from a compliance perspective, representation of an asset and a token is a token is a token isn't necessarily the same thing. So in the securities world, and we do it today, we tokenize everything as a digital security. That's what KoreConX and KoreTransfer operates under. But we're in a permissioned environment. We're in a trusted environment. If I get, and I'm going to do a shout out to those of you looking at saying, I want to build a marketplace in art or real estate or automobiles or whatever it is, the possibilities are endless. And you come and you say, I just built this beautiful platform, and say, now I want to transact. And I go, so, that's great. So what do you need from us? They go, oh, well, I need your transfer services. I need somebody to manage those shares. And I said, and you built a marketplace because you want to do what? And they said, I want to have a wallet. I want a wallet so that I can have my assets in my wallet and I can trade them all over the place. Well, you didn't start with the regulations first. The regulations don't allow you to do that. It doesn't allow me to take my securities and not have a book of records of those securities somewhere. So imagine but we're used to doing that with NFTs. We're used to doing that with other asset classes. They're just not digital securities. So close out on that point there is, don't ever make the mistake of build first and then come to the regulations and realize you can't transact, or you've created significant friction and spent a lot of money in doing so. The opportunities are great for these regulations. Reg A's, going down the series route, Reg A's for marketplaces, Reg CFs as a direct offering. And I don't want to dissuade, by the way, anything from funding platforms. Funding platforms, I encourage lots of companies to say, you're in a good position to say, start your capital here. Is a funding platform going to help you with the piece? Just don't expect that somebody has an audience and you're going to be able to capture that audience. Pros and cons to all of it. Do your homework. They both have a place and they can service you under these regulations. And very often companies are saying, I'm doing some Reg CFs, I'm doing some Reg A's, I'm doing some Reg D's, I've got some VC capital over here. Whatever that is, these are simply options and you want to be thoughtful and plan up front. So know the regulations, understand that the tech's evolving for private companies to have not 1,000, 10,000, 50 and 100,000 private investors on the cap table. We manage that kind of thing. And that's a shocker. How do you manage that? I don't want too many shareholders. Well, it's kind of like the public narrative of, hey, I'm Apple. I don't care how many shareholders I have. It's all being managed. It's technology that's driving this. There are some regulatory questions that you need to ask, and you need your lawyers and your broker dealers to also discuss with you about what happens when I get to certain thresholds with my investors and shareholders, what type of reporting that I can do. So the better you leverage technology up front from a reporting perspective, kind of like doing my taxes, if I actually don't just put everything in a shoebox and I actually document it up front, my life's easier a year down the road. And you have to make those considerations, when you're doing your raise. So you got your pre-raise, during the raise, and post-raise. Engage your investors along the way. We're coming up on the top of the hour here. Any comments on that? If the SEC comments, 2 weeks to get comments and a few days to compose and send responses. Doug, you want to jump in on that?
Yeah, well, Dina had just asked a question, how long is the SEC taking to approve Reg A's? And I mean, really the big factor there is just, are there comments? If there's no comments, if it's a no review, no comment situation, we'll typically hear back in 3 to 5 business days, which is phenomenal as far as I'm concerned, seeing as they're a government agency. If there are comments, then 1.5 to 2 weeks to actually get the comments from the SEC, a couple days to turn it around. And then from there, it just depends on whether or not the responses satisfy the SEC. Certainly, you can end up with more comments. So obviously, there are Reg A issuers that have gotten into situations where they have a couple months of dealing with comments. Normally on something like that, though, that's going to be a pretty complex business model, or there's just, a lot of sophistication and complexities in their business model that they're contending with. Something simple like a real estate fund, we're, usually not expecting to see, usually comments on something like that. Total prep time. I mean, it just depends on how quickly the client's getting us information. 60 to 90 days to draft the Form 1A, assemble all the exhibits, get sign-offs and consents from everybody, and then file to the SEC. The only other factor to keep in mind is FINRA clearing the 5110 filing. I think FINRA, at least earlier this year, kind of appeared to be a little overloaded, in my opinion. So a lot of that also comes down to that, because if you have a BD of record on board, that 5110 filing has to be cleared before you can launch the offering.
Good. So quicker for some. What about FINRA coming into the mix here? I get clients that go, hey, I got qualified with the SEC and now something's held up with FINRA. Well, how does that come into the mix? Richard?
Yeah, so the SEC won't fully qualify the offering until FINRA issues what's called a no objections letter. The no objections letter is basically FINRA checking the deal, and they're not looking at it. They're looking at it from different lens than the SEC is. What they're looking to see is the broker dealer, the managing member, like Texas Capital, are the terms that they've arranged with the issuers fair? The subscription agreements look okay? Is the escrow in place? These types of things. So they're not looking at the Form 1A so much, mainly the arrangement between the broker dealer and the other parties there. So they will, if you go to their website, they'll say and for Reg A, it's considered a public filing, so it's the same whether it's an S1 or a Reg A. They say it's a 10 to 25 day period. If they come back with questions, that kind of clock restarts again. But in my experience, they keep within that period. And then if there's a follow-up and there's more questions, then it's generally much quicker to tidy up.
Well, gentlemen, any closing thoughts? I really appreciate you being part of this educational summit. The next one is next Wednesday and Thursday. There's new summits each week for the next 4 weeks going into November. All different subject matters. Jason, any final takeaways or comments?
The success rates of entrepreneurs, year 1, year 5, are not great. Capital raises at the VC level, and as Richard was talking about, some of those funds drying out in general. Historically, not even speaking to the past few years, it's certainly not 100%. I've seen well under 10% that are successfully completed. Equity crowdfunding, the top 10% of campaigns on Reg CF, we're able to see a lot more data there, are moving. The bottom 50%, pretty stagnant. I think the big differentiator is marketing, planning, having realistic approaches to this that reflect digital best practices as you're looking to use these digital tools. So as I said earlier, start today. Feel free to reach out to us, reach out to other marketing experts. This isn't a pitch for us, but bring in all the resources you can. And KoreConX is connected with all different types of groups in marketing, folks like Douglas, Richard. Bring as many resources as you can, not just in marketing, to the table to increase your likelihood of success. And when you're able to crack the code, when you're able to get the social dynamics in your favor on these type of public raises, public-private raises, you will see the power of them. But if you're, holding back and wanting to see, the best cost of capital before you can even start investing more into marketing, and you're just going to be working backwards and having trouble seeing any type of tangible movement whatsoever. So leverage the resources at your disposal. Everyone on this call, all the marketers in the space, not just us, but don't sell your brand, don't sell your raise short. Education, plan and find the right team. Doug.
Yeah, I'll reiterate what I said at the beginning. I mean, it's actually a fantastic time to go raise capital as far as the programs, the technology goes. I mean, I remember pre-Jobs Act having these calls with people where it's like, okay, well, you'll put the offering in place for us and get the filing work done, and that's great. But, how do I get this thing exposure if I can't go out on my Facebook or my corporate site? So I think ultimately the fact that we're sitting here with fantastic technology to not only get people through the investment process, but manage them on your cap table. But the fact that the regulations have changed and it's really freed up the ability for companies to go raise capital. And like I said, at this point now, there's a program that's going to probably almost directly fit your needs. And so I'm going to end with that. It's being in this business 24 years, it's a great time right now in the industry. And if you do need to raise capital, the tools are there. The regulatory changes have been in place for a while. They're mature. And obviously, as Jason said, just get a good team on board. You're going to want a good team to get you through the process.
Perfect. I love the enthusiasm. I like the optimism out there, especially when things are not always optimistic. There's a lot of negativity out there. out there in the news, and we don't hear a lot of the good things. I'm seeing companies making significant strides with the raises. I'm also seeing lots of companies that aren't successful with the raises. You got to, this isn't just put it up there and they will come kind of mindset. Richard.
Thank you, Peter. First of all, I think it's been a great panel. I got a lot out of it. I'm sure that a lot of people watching this, either now on the replay, will get a lot out of it. Just want to reiterate what everyone said. We have some really good options now for capital raising. You don't, if you're a startup founder, you don't just have to, you send your emails off to VCs and hope they get back to you. You can do a 506D and seek credit investors in line with the Reg CF. Reach out to your network, to retail investors, to your community. Make your make your customers become investors, and your investors become customers. A lot of options there. And one thing we didn't even touch on here, but if you work with a firm like Texture Capital, we have an ATS as well. So even down the road, you can have secondary trading for your investors as well.
I was remiss. We're going to have another panel discuss what are the liquidity events that can occur. Doug touched on something called selling shareholders early on from a pre-prep perspective. Richard's closing out with secondary trading from an ATS, the concept of marketplaces. There's so much more that we hope to discover over the next month. And I'm sure some of our panel will be joining us in some of those sessions as well. So to everybody, have a fabulous day. And I really, really enjoyed everybody today. So thanks so much, guys.
Thanks a lot.
Thanks, everyone. Take care.